Welcome to CFTC Talks. I'm your host, Andy Bush. Hey, just a quick reminder, there's a disclaimer at the end of the show that's important for you to hear. By the way, we're going to do something a little bit different once a month here on CFTC Talks. I'm actually going to share the potato or microphone with my colleague and friend from the CFTC, Dan Gorfine. So most of you have heard Dan on the show a couple of times as he is the Chief Innovation Officer and Director of Lab CFTC here at the agency. And we really both thought it would be a great idea to get more guests on to discuss the latest trends in the fintech space. So, Dan, welcome to CFTC Talks.
Thanks a lot, Andy. It's great to be on with you and to expand our ability to share with the public some of the work, learnings, and areas of focus of Lab CFTC.
Yeah, I'm glad I hoodwinked you into coming on consistently.
No, my pleasure.
Yeah, I'm excited to do this just because this is such an interesting space. But, from the Chief Market Intelligence Officer side of me, we're on a journey of learning, really, about the markets we watch. And ladies and gentlemen, Dan and I want to continue that to explore the world of technology and how it's impacting the structure of the financial architecture that's in our country right now.
Yeah, no, absolutely, Andy. And I think, as in other sectors of the economy, we're seeing the internet, mobile technology, the increasing power of computing. All of these things are changing models and kind of the core operations of finance and markets. We're seeing the impact of emerging technologies, including blockchain, machine learning systems, smart contracts, and cloud. And similar to end users and market participants, we in the government are taking steps to be sure that we can keep pace and skate to where the puck is headed. And I know our guest today will help us with that conversation.
Yeah, I hope so. I'm excited to get to it. But, I know all of this for everybody out there. I know this all sounds a little bit wonky, but there are big changes happening, and it's a good idea to talk with smart people who are deeply involved in those shifts. And to that end, we turn to somebody who's enmeshed in the very fabric of fintech as an entrepreneur and as an investor. So Alex Rampell is a general partner at the venture capital firm of Andreessen Horowitz, where he leads the firm's fintech investments. Alex, welcome to CFTC Talks.
It's great to be here. Thank you very much.
Yeah, and Alex, it's great to have you on and to continue conversations regarding the impact of technology that we began many, many years ago when we were students together.
That's right, and the Mac versus PC wars of the 1980s.
You may have won that battle.
Well, Alex, you started and invested and helped manage really some of the most fascinating fintech companies out there, from TrialPlay to PeerStreet to Pinterest. And Dan and I are looking forward to hearing your views on a wide range of issues. But before we do, I have to ask you about your early days as an entrepreneur. Actually, your very early days, like at the age of 10. So I want to ask you, how did you get interested in writing and selling shareware programs at the age of 10? And how did that experience shape your interest in views in the space?
Sure. It's actually kind of all a straight line, well, somewhat of a bumpy straight line, but it's a linear progression from then where I got a Mac, and as Mr. Gorfine has mentioned, he had a PC back then, and there was very little software for Mac in the 1980s.
Right.
So I complained to my father, who bought me this very expensive computer. Actually, my grandmother bought me this very expensive Macintosh 2, the first color Mac. And there's no software for this. There are no games. There's no nothing. Like I was an ungrateful little child, and I wanted a PC like my friend Mr. Gorfine had. And my dad said, well, why don't you learn how to write your own software? So I got a book on C, and I started writing these little programs. The first one that I wrote was a screensaver, so it would draw ovals on your screen. I uploaded it to the then nascent internet, really things like AOL, CompuServe, and I said, hey, if you like this program, send me a check for $5. And lo and behold, a few days later, somebody sent me a check for $5, and then somebody sent me a check for $20, and I was making about $100 a week writing software and selling it on the internet for $5 or $10 a pop. And this little side project kept growing, and actually that's how I got into payments, and that's how I got into fintech, was because when this got to a more critical scale of, I had this one product in 1996, so it was about 15, that lets you stay on AOL forever, which people that were alive and remember this back then, it was an acute problem for people that used AOL in the 90s. And this thing sold like 100,000 copies. So on a good day, I would get 1,000 checks in the mail every day. It was phenomenal. And it was a pain to get checks in the mail. It was great to get 1,000 checks in the mail for $5 or $8 or whatever it was each. But the problem was, is there a more efficient way of accepting payments online? So I bought a credit card terminal. I figured out how to get a merchant account, and I got into payments, and I got into all these other elements of finance largely to figure out how to deal with inefficient payments of the 1990s for shareware. Try before you buy software on the internet. And that's even where this company TrialPay, which I eventually sold to Visa, came from, which was most people don't like to pay for digital goods. You might pay $10 for a glass of wine, but to pay $10 for one song on iTunes, nobody would do that. That's a ripoff. It's digital. You can't touch it. Why would you pay $10 for that, even though you might listen to that 1,000 times over? So it seems like a pretty good deal at $10, but 99 cents seems to be the breaking point for that. So TrialPay took this problem that I had suffered from really since I was 10 and said, hey, if you don't want to pay for my shareware, I'll give it to you for free if you shop at the Gap, or if you sign up for Netflix, if you do something else that has value in the economy. The whole underpinning of advertising is consumer sales. So the reason why companies advertise is because they want people to buy their products. What if Gap could say, hey, you don't want to buy Alex's product, we'll give you Alex's product for free if you go spend $100 at Gap. Gap has a 50% gross margin. So that's where this company TrialPay came from. And it kind of all dates back to, as you mentioned, kind of the early 1990s when I started selling shareware.
Well, I have to say, Alex, hearing all of this definitely makes me question my decision to go into law instead of computer programming. But with that being in the past, let's jump forward to the present. So there's a lot going on in fintech, or advances in financial technology, and a lot of that activity is also taking place in Silicon Valley. So let's just start out with a big picture view here. How do you define fintech, and what areas are you most excited about investing in, and why?
It's a very good question. So the joke that I like to make is that if you are a 200-year-old financial institution, you're probably called a bank. If you're a 2-year-old financial institution, you're probably called a fintech firm. So in many cases, fintech, it's more of like, it's the hot new term, but it's often referring to just doing the same thing that other financial institutions have done for a long time, but doing it where your chief executive might have an engineering background, or where venture capitalists go invest in the company. But if you think about like Lending Club was one of the first companies of the new fintech revolution. Lending Club, the idea of doing refinance of your credit card debt isn't anything new. The idea of doing it without physical location and just a website, you could argue that is the next generation. So the way that I think about fintech is I really group it into 4 categories, and these are arbitrary 4 categories, but the first is doing things that banks do. So I think of banks kind of consumer standard savings and loan type institutions. They save money, they lend money, and they send money. Those are kind of the 3 main functions. And all of those can be done in a locationless form, because if you look at all of the big bank mergers of the last dozens of years, a lot of them were to expand the consumer geographic footprint. When I went to high school in Massachusetts, I had an account with a company called Baybank. Baybank merged with Bank of Boston to create Bank Boston. Bank Boston merged with Fleet to create Fleet. Fleet merged with Bank of America. So I ended up with a Bank of America account through like 4 mergers. And the reason why all of these companies kept merging was to take out cost and to have synergy, and everybody conducted business at a branch. So if you think about sending money, saving money, lending money, all of those things, you don't have to do them with a branch. I mean, it's kind of the same thing that happened with Amazon. Amazon unleashed this real revolution of you don't have to have a physical location in a town or a city to conduct business, because it can be done much more efficiently with a much larger catalog if it's done without any kind of geographic footprint and just let people do it from the internet. You don't need to go try on a mortgage. Now you can just take a picture of a check, and why do we even use checks to begin with? So kind of category 1 of fintech is just replacing things that banks do, where banks require 1-800 numbers, they require like very long pages of information, they require in-person location visits where people don't want that. So that's category 1. Category 2 I would broadly define as things that banks don't do. So as an example, there's a whole category called invoice factoring, where if you're a small business and you're owed money from GE and you've got an invoice that they've agreed to pay you, they might pay 90 days after the end of the month. You need to borrow money to make your payroll or to buy your goods that go into your widgets that you eventually sell GE. There's a big market for selling receivables. It's called factoring. And there are thousands of companies that do this all over the country. If you do a search on Google for small business invoice factoring, you'll find thousands of results. All of them have 1-800 numbers and kind of crappy 1990s like clip art. There's no marketplace for this. It's not technology enabled. So, you can think of that as one area where you say, hey, I'm going to be a tech startup. I'm not going to require people to call a 1-800 number. That's kind of a last generation thing. I'm going to build a real marketplace for this. Or I think you mentioned early on when I joined this podcast, I invested in the company called PeerStreet, which is doing this for hard money loans. So these are kind of speculative housing loans. So I might be a developer and I say, hey, I'm going to buy this house that's kind of falling apart. I'm going to fix it up and I'm going to go sell it once it's been fixed up, because there's a much bigger market for people that want fixed up functioning homes with like actual plumbing that works, as opposed to like old falling apart dilapidated homes. I can't go to Wells Fargo and get 5 concurrent 30-year mortgages for speculative housing. So this is a market called the hard money lending market. Again, there are thousands of companies that do this around the country already, but there's no marketplace for it. And marketplaces breed liquidity. Marketplaces make things much more efficient, because you don't want to go on something where you don't have price transparency and you only get one quote. You want to get thousands of quotes, and you want the marketplace to kind of drive that price as low as possible. So that's kind of the second category of, I would call it, it's a very, very broad category, because by definition, anything that banks don't do, like that could be anything, but anything that banks don't do that is kind of already happening in the dark edges of the economy, or not necessarily dark edges of the economy, but just it's not very well understood. There is a market for it. The market's already well defined. The market's already very, very big, but it's not consolidated. On the contrary, it's very fragmented. So that's category 2. Category 3 is another big one. It's insurance. Now, some people are calling this insurtech, but I still call it fintech. It's actually kind of a fun little thing to do is if you go to the jobs page for a lot of insurance companies and you just kind of look for what jobs they're looking for, if you type in COBOL, which is a programming language which has basically been extinct for about 35 years, they're hiring dozens and dozens of COBOL programmers, which is kind of a good, I'm not making this up, it's kind of a fun exercise. I have screenshots from every insurance company and every major bank for how many current openings they have for COBOL programmers. I think State Farm has about a dozen.
Wow. So that says everything, really, right? That says everything you need to know about the state of where insurance is if they're still hiring for COBOL programmers.
Well, but it's banks too. But in all fairness to them, like it's much more. The technology is almost an afterthought. Like people don't get their insurance quote saying, "Ooh, this insurance webpage was built in a more modern Node.js setup and not using something from the 1970s." Like they don't care. They just want it to be as cheap as possible. There's actually an expression which I use a lot when I talk about fintech, which is the battle between every startup and incumbent comes down to whether the startup gets distribution before the incumbent gets innovation. And in most cases, it's not game, set, match, but it's kind of game, set goes to the incumbent because, think about insurance. Geico spends over $1 billion a year advertising their auto insurance, save 15%. I remember it by heart because I see the Gecko on commercials all the time. That's what they want. So it's very, very hard for a startup to go in with more modern technology and maybe a marginally lower price. And if they still have to buy customers by advertising on Google, by advertising on TV, and think about what venture capital firms do. We might give somebody for their first institutional round of funding $10 million, which sounds like a lot, but that's 1/100th of what Geico spends on 1 year just for this one narrow sliver of their OPEX called advertising.
Wow.
So insurance, a lot of the processes are a little bit backwards. A lot of the systems are not good. I mean, part of it I would call a cultural divide that enables almost all of these categories, and I'll name a fourth one in a second, is if you're over the age of, call it, 50, I'm making up that number, you might want to talk to a person. You're going to feel much more comfortable about whatever product you're buying, especially in finance, if you get to talk to a human or if you get to visit somebody in person. If you're under the age of 30, that's a bug. It's not a feature. Like, you don't want to, the joke that I make is the least used app on your phone is called the phone app. If you're under the age of 30, you don't want to call people. You want to text them. You just want to message back and forth. You want all communication to be asynchronous. it is literally impossible on the internet to buy life insurance without talking to a person. And that's not a legal requirement. That's not a regulatory requirement. It's just a lot of these systems are like, it's either an antiquated kind of social perspective, which is, oh, nobody will trust this. Like, we have to sell to customers. Nobody's buying life insurance. We have to sell to them. And it's kind of this idea of sell, sell, sell. Or, my sister works at the Washington Post, and she was at the New York Times before. And I remember she told me, like, the whole editorial staff, they would always think about, like, what's on the front page above the fold of the paper, the physical paper. Like, the physical paper was so important, and yet it was becoming more of an anachronism. Like, what's in the physical paper when the means of dissemination are increasingly electronic. And you could argue the same thing is true for a lot of these insurance companies, where it's like, okay, we got to sell, like, yeah, we don't want to let people do it online because we're going to have a higher conversion rate, which is actually true. Like, a lot of these products in insurance are better sold in person or over the phone because you have kind of a high pressure sales tactic. That might work well if you kind of draw a line in the sand of, like, above this age range, it works better. But there's certainly a very large group of people that are 25. They grew up, they're part of the Tinder swipe right, swipe left generation, and they don't like that. They want to just interact.
Alex, I think what's so interesting, I know we haven't heard your fourth category yet, but certainly with the three you've talked about, and I think that the common thread that runs through all of this, and you can't overstate enough how important the role of the internet and mobile technologies are in all of these areas now of financial services, and we've seen that impact. You were just talking about in media and in journalism, but you've seen the internet permeate all different aspects of various sectors of the economy, and it seems like that's kind of the wave or transition that you're describing here in financial services.
Exactly. I mean, it's kind of it's the Amazon effect, broadly speaking, because Amazon first, it was like, oh, I want to try stuff on in person because I don't trust this internet, or logistical advantages of being able to buy something same day. But at scale, it's like, all right, why would I try something online? Why would I try something offline when with VR or with video or with whatever kind of technology that has advanced dramatically in 20 years, it's just as good and almost as fast to just have it shipped to me. And I think the same thing is happening with financial services, where, like, again, it's kind of shifting from feature to bug to have this in-presence location or human being on the other side of the transaction, as opposed to just doing it effortlessly and electronically with as little information and a thumbprint down on your phone to go pay. I think that is the future. The question is, when do we get there?
Right.
And then, as I was saying, like the fourth category, which is probably a little bit more in the realm of all things CFTC, is capital markets. In many cases, these things are consumer-facing. So, like, I would say, look at the whole field of robo-advising, like Wealthfront or Betterment or others. Like, how do you redefine asset allocation? In other cases, it's like I was on the board of a company called KCG, which was recently bought by Virtu. We were a big investor in Bats, which eventually was bought by the CBOE. But, that was a multi-billion-dollar acquisition. They built effectively a new marketplace where speed was the primary objective. And it was redoing something where, ICE has been around for a long time, NASDAQ's been around for a long time. How do you do this better, faster, cheaper in the 21st century? And that's kind of more of from a Silicon Valley perspective, a much more esoteric thing, because a lot of people don't understand the underbellies of capital markets or how they work, or if I go buy 1,000 shares of XYZ stock in my E-Trade account, what actually happens and how many different pipes does that pass through? And it's not something that people understand viscerally because they're often not exposed to the pipes. They're exposed to the front end. So a lot of Silicon Valley engineers, like, they'll look at, there's a big opportunity to make the front end better. So let's build a company like Robinhood to make the front end better. There aren't as many people that are focused on the back end and saying, how do I make the back end better? The other kind of big category shift that I see happening in kind of mainly in investment allocation and just how markets function. If you look back 40 years ago, during the heyday of, say, Peter Lynch, a lot of the world was about stock picking. And the way that you make good returns, or you invest in mutual fund managers that spend lots of time on the ground, shoe leather style, figuring out buy this, sell that, or perhaps looking at it a little bit less charitably, what has the highest commissions that I can earn vis-a-vis my clients. Category two, or not category two, but like kind of round two was, okay, maybe this Bogle guy was pretty smart. It's all about fees and minimizing fees. And let's have this indexing approach where you're not picking stocks, you're just going into an index and This is the famous Warren Buffett bet that he won against the pool of hedge funds of the index outperforms. I think the third wave is actually going to be the second wave minus the first, which means a lot of index products are too rigid. So if you work, as an example, like the S&P 500 is market cap weighted. So if you work at Amazon, which is a $600 billion plus company, and your wife works at Apple, which is a $900 billion company, like that combined is more than 5% of the S&P 500. And if your kids work at Facebook and Google, now you're getting close to 10%. Like buying the S&P 500 might not be the right strategy. You actually might want more smart beta. Or the joke that I like to make is, I hate flying United Airlines. I've had so many bad experiences with them, I just won't do it. If I buy the S&P 500, I'm actually buying United Airlines as well. I should be able to buy the S&P 500, modulo my employer, modulo like the three companies that I don't like. And that's a direct indexing strategy. It's been around for a long time for tax efficiency for high net worth individuals, but it hasn't really been available for consumers. And this, I think, is probably the third wave, which is you want to take all of the cost minimization that you saw from wave 2, but actually integrate the kind of preferences and more idiosyncratic risk that consumers might have based on the correlation of seemingly disparate assets. So like if you have housing, if you own land in Silicon Valley, that's basically the same as a tech stock because the two things kind of fluctuate in tandem. So how do you get smarter about that? So kind of the fourth category are all things capital markets, whether consumer-facing, enterprise-facing, some of the back-end stuff, kind of new markets that will develop for things, or if you think about cryptocurrency. A lot of that isn't really fintech per se, and I can talk about that later, but the part of it that is fintech is how do you build a custodian for crypto assets? Because, State Street is really good at custodying things, or Bank of New York Mellon, they do a lot of this, but like how do you do it for these very, very bizarre crypto assets where effectively your ownership of them is not stored in a ledger in a sense that like PricewaterhouseCoopers would understand. It's basically ownership of a private key. How do you validate that? How do you audit it? How do you transfer it? Especially when you have, say, ETFs that might be doing this where you need to be able to buy and sell to match up with your NAV. You can't do something in the crypto world called cold storage. So there's a lot of really interesting things in kind of that fourth category, which is probably the most esoteric of the four that I cover.
Yeah, that was interesting. I like how you approach the investing problem from the standpoint of being able to actually improve the user experience in the sense of being able to give them what they want, to be able to strip out things instead of just, buy everything, right? And I think that's the concept behind it. Hey, Dan, why don't we just jump to some of the stuff that you were interested in about the fintech verticals here?
Yeah, no, that sounds good. And actually, just the one other thing I wanted to add about your fourth category there, Alex, I think it's a really good observation that it's the case that many innovators, especially out in the Bay Area, may not actually have as much familiarity with aspects of capital markets and CFTC regulated markets, for example. But one of the things that we are trying to do is get folks and innovators to pay more attention to our markets in terms of figuring out where technology can help improve efficiencies, drive down costs, decrease friction. So, agreed, that's a really exciting area and one that we think about a lot. But in any event, let's shift over to something that you mentioned there at the end. And of course, we can't have this conversation without talking a little bit about blockchain and virtual currencies. And you've done some thinking and some investing in the space. So why don't you, share with us a little bit, how do you think about blockchain technology, and then obviously the virtual currencies that are, at least for these public blockchain systems, tied to those networks? What's your thought? What's the potential promise, or where do you see that space moving?
Well, I think it's almost easier to define it by what it won't do or what it isn't well suited for, which is almost everything that the larger companies are saying they're going to use blockchain for. Like, which is kind of funny, but it is unfortunately true. Like, I meet these banks all the time. They're like, hey, we spend billions of dollars a year in IT. We're going to make that go to zero because we're going to use blockchain, and that doesn't make any sense. I mean, and actually, this is the element. Most companies, they just want a database. They're like, oh, I want blockchain because records are permanent and they can't be changed, and I can see what changed over time. Well, actually, every modern Oracle database does all of those things. The reason for something that uses blockchain is when you don't want to have any central authority that is involved in any way, shape, or form. And there are few cases where that makes sense, but there are many cases where that makes a lot of sense. And the issue of cryptocurrency, like there's something that I say a lot to these financial institutions that ask me for advice, and they often don't like what I have to say, but because I'm saying that their whole private blockchain effort doesn't really make that much sense. But you can't actually have a distributed ledger without a currency, because the whole point of cryptocurrency, I mean, like think about Bitcoin. Bitcoin's very interesting, but Bitcoin it's effectively trying to be its own currency, but take that away for a second. Why do millions of processors around the world and tens of thousands of nodes, why are they keeping track of this ledger of Bitcoin? The reason why
this is the economic incentive, right? You need to have that economic incentive.
Yeah.
Exactly. And that's the thing. It's like, so when you hear, it's like, oh, this is actually a real story. I met with the CEO and board of directors of a very large North American bank. They come to our office and they're like, well, we want blockchain, but we don't like Bitcoin because Bitcoin is bad. And we also want everything to be in our data center. So we want the blockchain in our data center not connected to anything else. And it's like, well, there's a company, it's called Oracle. They're in Redwood Shores, California. They do all of this. Like the reason, there's a really great article in the New York Times, I think it came out today or yesterday, that just talks about, kind of what is the promise, the actual real promise of a lot of these things. And it is to take things like the current era of tech incumbents is almost unprecedented. Like the market caps and the network effects that protect Facebook, Apple, Facebook and Google in particular, just because they really are networks. Like Facebook basically has a monopoly on human identity, and Google has a monopoly on kind of like human intent. So if you want to know who somebody is, like Facebook owns that monopoly. If you want to know where something is or how to do something or like find some information, Google has that monopoly. And they've turned those monopolies into, well over $1 trillion of market cap. And those are centralized. Like the information around like, I know you and we're friends and here are your friends, that's stored in the Facebook central database server. And likewise, the information and the algorithms that actually determine which information to surface, they're not transparent to people, and they inure to the benefit of these two large corporations. The other way of doing this would be to store it where nobody really owns it, which is part of the idea behind a lot of this blockchain stuff. But again, in order to do it, you need to have an incentive for lots and lots of parties around the world with nobody governing them, with no corporation in charge, with no payroll, with no checks being written. You need an incentive for these disparate entities to go store and maintain the security of this ledger that nobody controls. And that's what's really interesting about it. And again, that's why the currency aspect, you can't really say, I want blockchain without any kind of cryptocurrency, because you lose the incentive for participation.
And I guess, just following up what Dan was talking about, when you get into the ICO space and the tokens, which are an integral part of this, but you're also talking about, with Bitcoin and virtual currencies, you solve the double spend problem. But with the tokens, you're doing something that is called bootstrapping, and maybe you could just elaborate on that a little bit.
Yeah. So if you look at the most valuable companies on Earth, both now and historically, they have traditionally been networks. And networks meaning that, and this is where the term network effect comes from, like eBay is a network with a network effect, because the more buyers there are, like if every buyer in the universe for a baseball that's caught is on eBay, then your marginal seller will have an incentive to sell it on eBay and not anywhere else. And if then everybody who's selling is on eBay, then all the buyers want to go there. And then it's a virtuous cycle, and you can like picture this as a wheel where more buyers attracts more sellers, attracts more buyers, attracts more sellers. Airbnb is a network. Google is a network for information. Facebook is a network for your friends. So the question, though, is everybody recognizes that these things have lots of value at scale. It's also almost self-evident that they have no value at subscale. So Tinder with 2 people on it would not have that much value. Tinder with 20 million people on it would have a lot of value.
Right.
eBay with 2 people on it, no value. eBay with 20 million people on it, lots of value. How do you get there? And there are lots of different ways. Like in some cases, you start in a core market, like Facebook famously started at Harvard, dominated the Harvard campus, and then grew to Yale or something, and then kind of expanded concentrically outwards. But that's not necessarily a formula that can be repeated for success. So the idea behind tokens, is in many cases it's to solve this cold start or bootstrapping problem. So Tinder with 2 people, no utility. Tinder with 20 million people, lots of utility. What if you were to take the first few market participants from your next Tinder and say, hey, we are going to reward you with part of the terminal value of the network. So not giving you shares, but giving you tokens that you might use to interact with the network. So maybe to make a match on Tinder requires 2 tokens, so you have to buy them. They actually do have a Tinder premium service, I think, now. So what we're going to do initially is we're going to sell tokens to speculators, and speculators actually have a very important role here. You can't have a lot of these token-based approaches without having speculators. So sell these tokens to speculators. That convinces normal people that they have value. Because, wow, these dumb guys at Andreessen Horowitz bought lots of these tokens. Like, they must be onto something. I might buy some too. I'm an accredited investor, of course. And then eventually this gets more people to join the network. And initially the reason why they're joining is purely for financial utility, because there aren't enough people on the network to actually have any application utility. But enough people start joining the network for financial utility, and I have a little graph that shows this. It's hard to articulate over the phone, but eventually these things, the application utility has to take off. The hope is that the financial utility that's offered initially, like we backed a company called, or really a protocol called Filecoin. It's built by a company called Protocol Labs. And the example here is with hard drives. So storage space can be done in the cloud from Amazon or using Dropbox or Box. There are a lot of companies that do this, but they have a lot of capex to spend to kind of buy hard drives, hook them up to servers, hook them up to internet connections, make it all redundant, and then you spend $10 a month, you plunk down your credit card, and that's how you buy storage space. Another way of doing this might be to say, hey, everybody in the world, there are probably billions and billions of hard drives that have trillions and trillions of petabytes of space available. How do I incent people that have spare hard drive space available to join my network, offer up that spare hard drive space? Because that way I could convince people not to go store their files on Dropbox or somewhere else and maybe store them on Filecoin. And the way that you store something is you use a Filecoin. The reason why you offer up your spare hard drive is to earn a Filecoin. That's a great idea. But like Tinder with 2 people versus Tinder with 20 million people, the terminal state where a lot of people use it is going to be much more valuable than the initial start point where nobody's using it. So the way to jumpstart this, and this is exactly what they did, was they sold tokens. These are utility tokens that they don't entitle you to future cash flows from the business. They're in no way, shape, or form a security. They're basically like an arcade token where you go to the arcade, you go to Chuck E. Cheese, you put in $1, you get 5 tokens. The tokens let you use the gaming machines there. That's basically what Filecoin has done. But there is a transmutability where the people want to buy these tokens, and you can go sell them to somebody else. And again, like initially, this has speculative value. That's why we invested in it. That's what we do. This speculation is not a bad thing. It fuels a lot of innovation. All of venture capital is effectively speculation. But in this case, it actually helps grow the network because so many different people want to earn Filecoin right now that they've signed up on the supply side. They said, hey, I do have lots of spare hard drive space, and now I'm going to put it on the network because I want to earn Filecoin, and Filecoin has been ascribed a financial value. But eventually, like that doesn't work in perpetuity. Just like Tinder with 2 people, even if both of them are getting paid, doesn't work in perpetuity. You have to eventually cross this chasm and get to lots and lots of people using the network. And again, the hope is that this has solved a problem of bootstrapping, and that's why we think it's very valuable. Like it's kind of the way that I often put this is. Sorry, go ahead.
Oh no, Alex, I was actually gonna jump in because I know we're gonna run short on time, but let me let you finish, and then I have one lightning round question for you here.
Sure. I was saying, a lot of people say, Bitcoin, it's speculative, it has no value, and blah, blah, blah. And there are a lot of elements to those statements that would be correct. I would argue that Bitcoin, you can make all those arguments about gold because people would say, gold has value because, it looks pretty and because it's an electrical conductor and because people use it for tooth fillings. But it actually has no value for any of those anymore. Like people really use it they bury it in the ground. And they think it has value. Even in jewelry's case, it has value because people think it has value. So, but Bitcoin was interesting in that the Satoshi Nakamoto paper that launched Bitcoin, and this came out in 2008, Bitcoin is its own world. A lot of people that believe in Bitcoin, they hate the Fed. They don't like regulation. They don't like governments. Like, that's true. Some of them are just in it for speculative frenzy. But what I find interesting about Bitcoin was that it kind of came up with this idea of a decentralized network, along with not necessarily compensatory schemes, but a system for self-regulation and for network participation. And then that's been copied again and again and again for things as esoteric as hard drive storage. It's the same kind of like, how do you take advantage of, it's kind of like economic principles meets psychology, meets cryptography to making these kind of new paradigms work.
No, that's great. So, Alex, I don't want to let you go without asking you at least a lightning round question here.
Sure.
About the topic of machine learning and artificial intelligence. And to kind of set the context here, there's been a lot of buzz about these terms, and sometimes they're used interchangeably, which I'd like to get your thoughts on whether that's a mistake. But why now? It seems to me when you look at the history of data analytics, machine learning, every decade there's kind of a new enthusiasm for the space, and this idea that we may soon be near, this new era of general intelligence in computers, and it's going to completely transform, economies and how we transact. Where are we today? Is there something new here? And what are your expectations for this space? And of course, I posed it as a lightning round question, so we'll give you 60 seconds.
Yeah, nice one.
Wow, So with both this and blockchain, I could talk for hours. So a lot of this is also overhyped. Frankly, a lot of companies that we see that say we're doing machine learning, they just do if this, then that, which is not machine learning. Machine learning, the best way of thinking about it is often like if you learned what a linear regression is, which is you have lots of dots on a graph, two-dimensional graph, you try to figure out where do I draw the line to try to differentiate kind of top dots above the line, dots below the line, like what's the best place of doing that. A lot of machine learning is kind of almost a more advanced version of that, but with more dimensions. 2 dimensions being like your graph on paper. What if you knew every single variable about a person and you knew the outcome? You don't tell the computer, hey, if this, then that. Like if the person has this much income, then say this. If the person has this much income, then say that. You just kind of feed it in and try to figure out what happens. And the computer decides how do you place the weights, like where do you draw the line between the things above the line and below the line, but you're not talking about 2 variables. You might be talking about hundreds or thousands of variables. And frankly, a lot of this stuff, when done right, you can't actually tell why it worked. That's kind of the kind of bizarro thing, because it's not, human minds think, okay, well, I did this because of that. And in machine learning land, it's like, I did this because of, these 1,000 inputs against these 1,000 weights against those inputs, and I can't tell you it's because of this one particular reason. There are certain categories where machine learning does a great job. Like now, machines are actually better at recognizing images than people. There's a contest called ImageNet, so that's not generalized intelligence. It's called AGI, artificial generalized intelligence. Like we're a long way away from that, where computers think and decide to attack humans and all these kinds of things that I think naysayers say is going to happen.
I've seen that movie.
Exactly. Like that is very much overhyped. Like most of this stuff is really, it's like given a discrete task and lots of inputs. Like this is why Facebook and Google are so good at it, is not because they have the code. Like what's really interesting is that the system that Google uses for machine learning is called TensorFlow. And it's open source. Anybody can download it. The thing that you can't get is every single search query that went into Google or every single image that was uploaded or scanned by Google. And that's what actually makes it good. It's taking these kind of best practice. It's not a linear regression, but it's kind of that vein. Most of these things use DNNs now, deep neural networks. It's using that, but with lots and lots of data coming in so that you can actually start telling, aha, this is a cat and this is a dog, such that if you take a random picture of a cat that the computer's never seen before, it knows the classifiers and it can say this is a cat. And you can't necessarily say, but why? Was it because it had whiskers? Was it because the eyes were this far apart? No, you can't tell the reasons. And actually, this is often the challenge with a lot of applications of machine learning to finance, which is if you have a black box trading algorithm and you want to know, like, why did it buy or why did it sell? The answer is I don't know. Or likewise, you rejected a loan for an applicant given these 100 different pieces of information, none of which were discriminatory. Like you didn't ask gender, marital status, race, any of these things that are strictly forbidden, but you can't necessarily give the 3 discretely defined reasons for why the algorithm rejected the consumer. And that's one of the issues that probably... Yeah. Sorry, go ahead.
No, I was going to say these are areas that are going to raise some, very, very interesting regulatory questions and challenges. And I think, Andy, we have the topic of another show.
There you go. Well, now, okay, let me just get to one really last important question that Dan came up with, and I think this is important. Do you recall who won the USTA championship tennis match you played in South Olive, West Palm Beach, Florida in the early 1990s?
I do. Unfortunately, that was one Daniel Gorfine. That was a 3-setter.
All right, we're all done here, Andy. This is a great show.
Okay, fair enough.
That, my friends, is what we call a planted question. All right, general partner at venture capital firm Andreessen Horowitz, Alex Rampell, thank you so much for coming on the show today.
Of course, my pleasure.
All right, thanks, Alex. Great talking to you.
That was great. Thank you again. Hey, that's a wrap for CFTC Talks this week. Dan, thank you for joining me. It was a blast to have you on.
Yeah, my pleasure.
All right. And also, remember, if you want to hear more podcasts, you can go to our website, cftc.gov, and click on the podcast button, or you can find us on iTunes by searching for CFTC Talks on your podcast app. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening.